Do you ever wonder how Warren Buffett consistently picked the right companies that have made him one of the wealthiest person on the planet? Well, the secret lies in the way he chooses the management of these companies before he invests in them. Before we dive into those strategies, if you haven't watched the video on how Warren Buffett selects the businesses before investing, click the link in the description to watch that video. Now, this video is all about the strategies Buffett uses to choose the right management, the companies with the right leadership teams. Let's get started. Number 1 is the management rationale. Buffett believes that the most important task of management is the allocation of company's capital. This is critical because the way capital is allocated determines shareholders' value over long time. Deciding what to do with the company's earning, whether to reinvest in the business or return the money to the shareholders, requires a balance of logic and rationality. Rationality is the quality that distinguishes Buffett from other investors. So if you look at any company's growth cycle, after a period of peak growth, the company eventually reaches maturity. This issue of capital allocation becomes more important at that point when the company's growth rate slows and begins generating more cash than it is needed for development and operating costs. So the obvious question is here, how should these earnings should be allocated? If the extra cash reinvested internally can generate above average returns, then the company should retain its earnings and reinvest them. This is the only logical choice. Retaining earnings to reinvest in a company that generates below average returns, however, is completely irrational. A company that provides average or below average returns but generates excess cash has three options for allocating capital. Option 1, it can ignore the problem and continue to reinvest at below average rates. If a management continues to reinvest despite achieving below average returns, then the company's cash becomes a wasted resource and the stock price will decline eventually. This can lead to the end of the current management team and replaced by a new management team. Option 2, it can buy growth through acquisitions. Managers, to protect themselves from the option 1, they often choose the second option, buying growth by acquiring another company. Buffett is not interested in companies that rely on acquisitions for growth because it always comes with overvalued stock prices. Option 3, it can return the money to shareholders. There are two ways to do this, either by raising dividends or by buying back the shares. Raising dividends directly distributes earning to shareholders, while buying back shares increases the stock price. Additionally, buying back are often considered as a positive sign by investors, indicating that the company is performing well and the management has confidence to buy back its own shares. Number 2 is the management candid with the shareholders. Buffett has always emphasized doing business with people of the highest integrity. He admires managers who take seriously their responsibility to report fully and candidly to shareholders. Therefore, you should choose managers who are transparent with their shareholders and employees. Number 3, does the management resist the institutional imperative? If the capital allocation is so simple and logical, why is it often done poorly? Well, Buffett explains this is due to the unseen force he calls the institutional imperative. This refers to the tendency of managers to copy the behaviors of their peers or competitors. For example, if companies A, B and C are all following the same particular strategy, without any reason the CEO of company D may do the same, then this is called institutional imperative. Once Buffett spoke before a group of students and showed a list of 37 failed investment banks, but they are doing exceptionally well in the American stock market and they have hardworking individuals with very high IQs. He asked the students what may be the reason for the failure. He looked at everyone's face and told the answer, it is just mindless imitation of their peers that resulted in their failure. Now we know the three strategies, but how can we actually value the management? Well, Buffett suggests reviewing annual reports from several years back and paying close attention to what the management said in the past and how they are implementing their strategies now. It's a great way to compare those plans with today's results. Also read newspapers and financial magazines about the company and its industry. Keep in mind that some documents may contain inflated numbers and half-truths, so always do your own research. That's all for this video. Subscribe to the channel for more content like this.